They took their best shot. They waited for the cover of darkness. They raised margin requirements. They flooded the order book with paper shorts. They painted the tape red heading into the weekend. For 48 hours, they wanted the world to believe the silver bull run had died. They wanted panic. They wanted to surrender. They wanted the illusion of a crash. But when the sun rose over London, when the smoke cleared, the bull was still standing. What we witnessed was not noise. It was not a fluke. It was one of the most important market signals of the decade. No press conference, no central bank announcement, just the raw truth expressed through price action. The market didn't simply recover, it detonated upward. The violent gap up erased the entire engineered sell-off in a single session. That is not normal behavior. That is a scream. That is the sound of a bear trap snapping shut on the fingers of the biggest banks in the world. It is the sound of short sellers realizing the physical metal behind their paper bets no longer exists. It is confirmation that buy the dip is no longer a meme for retail traders. It is now the strategy of sovereign nations, industrial giants, and deep-pocketed institutions. If you panicked and sold during the drop, the truth is painful. You were the liquidity they needed. You were the fuel for the rocket. But if you held, if you understood the game, you are watching vindication unfold in real time. This analysis is not about predictions. It is about the crime scene. We are going to dissect how the banks tried to kill the price, and why, for the first time in 40 years, their weapon jammed. We are going to break down the mechanics of the V-shaped recovery and why this specific pattern signals that the low is in. The paper market tried to lie. The physical market just told the truth. This is the anatomy of a failed crash. To understand the violence of the rally, you must understand the trap that preceded it. Nothing in financial markets moves in a straight line. Bull markets are designed to shake you off. They inflict maximum pain on the maximum number of people. The sharp, sudden drop that terrified everyone was a textbook bear trap. The mechanism is simple. The banks know where the stop-loss orders sit. They know thousands of retail traders place automatic sells just below psychological levels like $60 or $62. To harvest liquidity, the banks must trigger those stops. So they use a catalyst, a margin hike, a scary headline, to push the price just low enough to hit the triggers. Snap, the stop fire. Retail sells automatically. A giant red candle appears. Bears see it and think the trend is broken. They pile in. They are short-tempered. They bet everything on a return of $50. But the trap closes because the banks aren't selling to exit. They're reselling to buy. They push the price down to generate selling volume, then absorb every contract. They buy from panicked retail. They buy from overconfident bears. And once their bags are full, they step back. Without artificial selling pressure, natural demand explodes upward like a compressed spring. The price gaps up overnight. Everyone who sold at the bottom is left holding cash they don't want. Everyone who shorted at the bottom is underwater. They must panic buy to cover. Their buying fuels the rally even more. This is exactly what happened. The drop was fake. The recovery is real. Weak markets bounce like a dead cat. Strong markets bounce like a tennis ball. Silver just bounced like a Super Bowl. We've talked before about the margin nuke, the exchange raising capital requirements to force selling. Historically, this was the ultimate weapon. In 2011, it worked flawlessly. They raised margins and silver collapsed 30% in days. Speculators vanished for a decade. They tried it again. They raised the cost of holding positions. At first, it looked like it worked. The price dipped, but then something unprecedented happened. The market absorbed the blow. Why? Because the composition of the market has changed. In 2011, the market was dominated by weak hands. Speculators using 20x leverage who could not survive a margin call. When the call came, they were forced to sell. Today, the market is dominated by strong hands, industrial users, family offices, and sovereign wealth funds. These players are not gambling. They are hedging supply chains. They are protecting generational wealth. They have deep pockets. When the exchange said, put up more cash, they didn't sell. They wired the money. This is a catastrophic signal for the manipulators. Their pain threshold calculations were wrong. They thought a 50% margin hike would break the bull. Instead, it barely annoyed it. When a market ignores bad news or regulatory attacks, it signals extreme underlying strength. It means buyers are not price sensitive, they are volume sensitive. They care more about securing metal than about what the margin requirement is. The failure of the margin nuke is the all-clear signal for the next leg higher. The banks fired their silver bullet, and now they're standing there with an empty gun, staring at a charging rhino. This brings us to psychology. Markets run on greed and fear, but the most powerful engine is regret. A V-shaped recovery, a crash followed by an immediate surge to new highs, is a regret machine. Think about the trader who sold on Friday. He thought he was being smart. He planned to buy back at $55. He went to bed feeling safe. Then he woke up Monday morning, and silver was higher than where he sold. He didn't save money. He lost his position. Now he must choose. Admit he was wrong and buy back higher, or wait and pray for another crash. Most people wait. They refuse to buy higher. They watch the price climb to $65, $68, $70. Regret becomes FOMO. Eventually they panic and buy at the top. This is how bubbles form. The shakeout removes weak believers early. It lights the train so it can accelerate, and it forces skeptics to chase. This volatility was a cleansing event. It washed out leverage. It reset sentiment. It turned overbought conditions into neutral conditions without breaking the trend. Whether engineered or natural, the result is the same. The path of least resistance is now higher. But who bought the dip? Not retail. Retail was terrified. The volume data tells a different story. The buying began in Asia, but it exploded in London. And this is the critical shift. For decades, London has been the suppression engine of the precious metals world. The LBMA was the seller of last resort. When New York panicked, London sold calmly to cool the market. But today, London didn't sell. London panic bought. When the UK market opened, massive aggressive bids hit the tape. This is a complete change of character. It's like watching a firefighter pour gasoline on the fire instead of water. Why did they switch sides? Not ideology. Banks don't have ideology. They have liabilities. They switched because of one terrifying metric, the float. London switching sides was not a small detail. It was the moment the market revealed its true condition. For decades, London was the pressure valve. Whenever silver ran too hot, London released supply. Whenever New York panicked, London steadied the ship. But this time, when the banks reached for the lever, nothing came out. The float, the metal actually available for sale, wasn't low. It was gone. And that is why the banks panicked. They weren't buying because they suddenly believed in silver. They were buying because they had no choice. To understand the magnitude of this shift, you must understand the difference between inventory and float. Analysts love to point at the LBMA vault data and say, look, there are still 800 million ounces in London, but there is no shortage. Technically, the number is correct, but the interpretation is catastrophically wrong. That 800 million ounces is an iceberg. The vast majority, 85 to 90%, is spoken for. It belongs to ETFs, sovereign wealth funds, and long-term holders who vaulted their metal years ago and never intend to sell. That metal is not part of the market. It is not available. It is not liquid. It is not a float. Float is the metal that matters. Float is the metal that can be sold today. Float is the metal that can be delivered to a refinery, shipped to an electronics manufacturer, or used to settle a COMEX contract. Float is the metal that keeps the system functioning. And over the last 3 years, the float has been drained relentlessly. India bought thousands of tons. Industrial users bought aggressively. Sovereign funds accumulated quietly. They didn't buy ETF metal. They bought the float. They emptied the dealer's pot. So today, when the banks look into the pot to smash the price, they find it empty. The iceberg is still there, but the tip, the part that matters, has melted. This is why London panic bought. This is why the banks switched sides. They weren't trying to push the price up. They were trying to survive. To understand the desperation, you must understand the leasing market, the dark heart of the silver system. Bullion banks don't just store silver, they lease it. They lend metal to industrial users who need it for manufacturing. The user takes the silver, uses it, and promises to return it later with interest. This creates liquidity. It allows the same ounce to be leased, returned, and leased again. It creates the illusion of abundance. It creates a virtual supply. But what happens when the industrial user consumes the silver? What happens when it becomes a solar panel, a battery, a circuit board? They can't return it. They must buy new metal to close the lease. For years, this was easy. Silver was cheap. The float was abundant. But now, the float is gone. Refineries are halted. Industrial users are calling the banks saying, we can't return the metal. We can't find any to buy. This is when lease rates spike. When lease rates spike, it is the market screaming shortage. It means banks are desperate to get their physical metal back. And today, the leasing machine is jamming. The banks are realizing the metal they leased out is never coming back. It's gone. It's on rooftops in Europe. It's inside EVs in America. It's in electronics across Asia. It is dispersed, unrecoverable, and permanently removed from the system. This creates a hole in the bank's balance sheets. They show silver assets on paper, but the vault is empty. To fix this, they must buy physical bars at any price to replace the missing metal. This is the London pivot. The banks are not speculating. They are not bullish. They are not chasing momentum. They are plugging holes. They are covering physical shorts. They are trying to avoid a regulatory disaster. This is the most explosive form of buying pressure imaginable. It is price insensitive. It is urgent. It is forced. They don't care if silver is $62 or $65. They need the metal. And when forced buyers enter a market with no float, the price does not rise. It detonates. But the leasing crisis is only one layer. There's another, the unallocated account. Many wealthy investors hold silver in unallocated form. This means they don't own specific bars. They own a claim on a pool of metal. It is like depositing cash in a bank. You don't own the specific bills, you own a claim on the bank's liquidity. For decades, banks ran a fractional reserve silver system. They might hold 100 ounces of real metal for every 500 ounces of claims they sold. They assumed not everyone would ask for their metal at once. But the Samsung battery news, the China export rumors, and the Friday volatility changed everything. Family offices began to say, I don't trust the unallocated system anymore. Convert me to allocated. I want specific bars. I want serial numbers. I want my metal moved to a private vault. This is a bank run, not on cash, but on silver. When a client converts from unallocated to allocated, the bank must take real bars out of the general pool and assign them to that client. That metal is removed from the float permanently. If the bank were running fractional, holding only 20% real metal, and 30% of clients demand allocation, the bank is insolvent. They must rush into the market and buy the missing bars. This is exactly what fueled the rally. It was a silent bank run, not people lining up at coin shops. Billionaires were sending legal notices demanding physical segregation of assets. The banks tried to crash the price on Friday to scare these people away. It failed. The demand for allocation increased, so now the banks are forced buyers. The bear trap caught retail shorts. The float trap caught the banks. This brings us to the next battlefield, the $65 level. Silver is trading around $63.50. The Friday losses are gone, but $65 is not just resistance. It is the kill zone for the shorts. It is the line they must defend. It is the wall that, if breached, triggers a chain reaction. The entire silver market is now staring at one number, $65. We're trading around 63 and change. The Friday losses are raised, the bull back on its feet. But 65 is different. 65 is not just a resistance level. It is the line in the sand. It is the place where the short sellers' liabilities explode. It is the point where the banks will fight with everything they have, because above that line, the game changes. Above that line, the defenders become the buyers. And above that line, the market enters vacuum air. To understand why 65 matters, you must understand the derivatives market. Speculators buy call options, bets that the price will rise. Right now, there's a massive concentration of open interest at the 65 strike for the December and January contracts. Millions of ounces are tied to that number. If silver stays below 65, those options expire worthless. The banks that sold them keep the premium, they win. But if silver crosses 65, the banks are on the hook to deliver millions of ounces at a discount. That is a nightmare scenario for them. This is where delta hedging comes in. As the price approaches 65, the market makers' algorithms force them to buy silver futures to hedge their exposure. If they sold a call option on 5,000 ounces, they might need to buy 2,000 ounces of futures just to stay neutral. But their buying pushes the price higher, which increases their risk, which forces them to buy even more. This is the gamma squeeze, a self-reinforcing feedback loop. It is what happened to GameStop. It is what happened to Tesla. And silver is sitting on the edge of the same mechanism. If silver breaks 65 with volume, the market makers flip from neutral to forced buyers. They will have to chase the price upward, 66, 67, 68, just to cover their exposure. This is why the banks will defend 65 with everything they have. They will throw paper at the market. They will trigger stops. They will try to create fear. But if the physical demand from London and Asia keeps pushing, the dam will burst. And once it bursts, the price will not rise gradually. It will accelerate. We are approaching the U.S. market open. This is the moment of truth. Historically, the U.S. Open is where rallies go to die. The pattern has been consistent for years. Asia buys, London buys, New York smashes. The 10 a.m. smash became a meme because it was so predictable. But today feels different. Why? Because American investors are waking up to the same news that terrified London. They are reading about the Samsung battery breakthrough. They are hearing the rumors about China restricting exports. And most importantly, they are seeing the chart, a giant green candle. American investors are momentum chasers. When they see silver up $1.60 overnight, they don't think it's too expensive. They think they're missing out. FOMO is a powerful force. We are likely to see a wave of retail buying hit the ETFs at the open. When money flows into the ETFs must buy physical metal to match the inflow. This adds another layer of buying pressure on top of the London bid. But there is an adversary, the dollar index. The Federal Reserve and the U.S. Treasury watch silver closely. A runaway silver price signals inflation. It makes the dollar look weak. Often during the U.S. session, you will see a sudden rally in the dollar index, a coordinated attempt to cool commodities. So the battle at the open will be the FOMO crowd versus the dollar defense team. If silver holds steady through the morning session, if there is no violent reversal, then the shorts are in serious trouble. It means the dollar defense failed. It means U.S. investors have joined the global stampede. Volume is the key. If the price rises on high volume, the rally is real. If it rises on low volume, be cautious. But given the bear trap setup from Friday, the odds favor the bulls. There's another signal to watch: the mining stocks. On Friday, when silver dropped, the miners were obliterated. First Majestic, Pan American, and Hecla, all down 4 or 5%. Investors treated them like the world was ending. But today, silver is back up. Mathematically, the miners should gap up massively at the open. If silver is at 63.50, these companies are printing money. But miners often lag the metal at turning points. Wall Street is slow. They wait for confirmation. They want to make sure the rally isn't a head fake. This creates a temporary arbitrage opportunity. If silver holds its gains, the miners must catch up. It is basic math. The rubber band between the metal and the stocks is stretched. When the U.S. market opens, watch the junior miners ETF. If silver is up 3%, the juniors should be up 6 or 7. If they're only up 2, that is an opportunity. It means the stocks are on sale relative to the metal. This disconnect happens because equity traders are scared. They remember Friday. But commodity traders know the shortage is real. Eventually, the equity traders will panic buy the miners. The catch-up move can be explosive. So we have the setup: the 65 gamma wall, the US FOMO wave, the mining stock lag. The next 24 hours will be volatile. There will be spikes, there will be dips. But the bigger picture matters more than the intraday noise. Whether silver closes at 63, 64, or 66 is irrelevant for long-term investors. The forces driving this move, the Samsung breakthrough, the China hoarding, the empty vaults, are not day trade forces. They are structural forces. They do not disappear at the closing bell. This brings us to the next phase, the end-of-year window. The moment when hedge funds that ignored silver all year suddenly need to buy it, not because they believe in it, but because they need to look smart on paper. We are now entering the second half of December, a period that carries its own gravitational pull in financial markets. This is the time when Wall Street dresses the shop window. The end of the fiscal year forces hedge funds and mutual funds to prepare their annual reports, the glossy documents they send to clients to justify their existence. These reports list the assets they hold. And here is the psychology of a fund manager. If silver becomes the asset of the year, driven by technology breakthroughs and structural shortages, and the fund holds 0 silver, the manager looks incompetent. Clients will ask, why didn't we own the best performing asset? And incompetence gets punished. It gets people fired. So what do they do in the final 2 weeks of December? They buy the winners at any price. They don't care about valuation. They don't care about timing. They care about optics. They want to be able to say, look, we owned silver. We participated in the rally. This is window dressing. It creates an artificial but powerful tailwind into year end. Funds that ignored silver at $30, $40, $50 are now forced to buy at 63 simply to save face. They are price insensitive. They just need the position. This institutional FOMO is what drives parabolic moves in late December. We saw it with tech stocks. Now we are seeing it with commodities. The Samsung news gave them the narrative. The price action gives them the urgency. So if you see silver rising on low holiday volume, don't be surprised. It is the smart money trying to look smart after being wrong all year. And you, the one who bought at 25, at 30, you are selling your overvalued silver to their desperate hands. Or better yet, you're not selling at all, because markets are cruel machines. They are designed to transfer wealth from the many to the few. They move in the direction of maximum pain. And right now you must ask yourself, what outcome causes the most pain to the most people? Scenario A, silver crashes back to 50. Who does this hurt? The silver bugs. But silver bugs are immune to pain. They've held through decades of suppression. They don't sell dips, they buy them. A crash doesn't generate liquidity. It tightens supply. It strengthens conviction. It does not serve the system. Scenario B, silver rises to 75. Who does this hurt? The banks, which are short hundreds of millions of ounces. The industrial sector, which needs silver for solar and batteries. The public sitting in cash while inflation eats their savings. The hedge funds are underweight commodities and terrified of missing the move. Scenario B causes maximum pain to the establishment. It blows holes in bank balance sheets. It forces the industry to panic. It humiliates the pros. Therefore, according to the laws of market sadism, Scenario B is the most likely outcome. The market wants to squeeze the shorts. It wants to force uninvested capital to chase. The bear trap on Friday was the final attempt to shake you off the train before it left the station. If you're still on board, you are aligned with the pain trade. You are inflicting the pain, not receiving it. Now zoom out. Why does this 160 move matter? Because it confirms the wealth transfer. For 40 years, wealth flowed from real to financial, from factories to derivatives, from gold to treasuries, from silver to tech stocks. That tide has turned. The Samsung battery isn't just a gadget. It is proof that the physical world is reclaiming its value. You cannot print a battery. You cannot print a solar panel. You cannot print an ounce of silver. You must dig it. When silver gaps up while the bond market wobbles, it is the market voting for reality. It is the market saying that an ounce of metal, which requires geology, labor, and energy to produce, is worth infinitely more than a digital entry on a central bank's balance sheet. You are living through a historic pivot. Your grandchildren will ask what you did during the resource crisis of the 2020s. Did you hold paper or did you hold metal? Friday was a test of your conviction. If you held, you passed. Monday is your reward. The day the bear trap failed, the day London panicked, the day the path to 65 opened. But victory does not mean the war is over. The volatility will intensify. $2 swings will become $5 swings. $5 swings will become 10. You must harden your stomach. If you are over-leveraged, you will be washed out. If you stare at the ticker every second, you will lose your mind. The strategy remains simple. Accumulate physical, secure unhedged miners. Sit tight. The market is doing the work. The shortage is doing the work. Samsung and China are doing the work. Let the institutions chase the price. You are already seated. And now, with the psychology, the structure, and the macro forces aligned, we enter the final chapter. The conclusion of the entire move, the end of your target, and the mindset required to survive what comes next. The macro picture is now unavoidable. The market has spoken, and it has spoken with force. The 160 surge wasn't just a price move, but it was a declaration. It was confirmation that the floor has shifted upward forever. A few years ago, $30 was the ceiling. Now $61.50 is the floor. That is the new reality. That is the new valuation model. The market is telling you that the era of cheap silver is over. The world has crossed a threshold, and the buyers who stepped in at $61.50 weren't Reddit traders or weekend speculators. They were billionaires. They were sovereign funds. They were industrial giants. They were the people who don't chase trends. They create them. As we move toward the end of the year, the forces driving this rally are not weakening. They are strengthening. The seasonal window we are entering is notorious for amplifying momentum. It is the time when hedge funds that ignored silver all year suddenly realize they cannot afford to look wrong. It is the time when the pain trade becomes the dominant force. It is the time when the market punishes hesitation and rewards conviction. And this year, the setup is more explosive than anything we have seen in decades. The psychology of the fund manager is simple. They don't need to be early. They need to be right at the end. They need to show their clients that they were part of the winning trade. They need to avoid embarrassment. They need to avoid the question, why didn't we own the best performing asset of the year? So they buy. They buy not because they believe in silver, but because they fear being left out. They buy because their careers depend on it. They buy because the chart forces them to. And their buying becomes fuel for the next leg higher. This is why late December rallies often look irrational. They are not driven by fundamentals. They are driven by optics. They are driven by fear. They are driven by the need to appear competent. And in a market where the float is gone, where the banks are trapped, where the leasing machine is broken, where the unallocated accounts are being converted to allocated at a record pace, this kind of forced buying becomes a blowtorch. But the deeper truth is even more profound. The rally is not just about silver. It is about the shift from a financialized world to a physical one. For 40 years, the financial system rewarded paper. It rewarded derivatives. It rewarded leverage. It rewarded speculation. Real assets were ignored. Real resources were undervalued. Real commodities were suppressed. But that era is ending. The Samsung battery breakthrough is not just a technological milestone. It is a symbol. It is proof that the physical world is reclaiming its power. You cannot print a battery. You cannot print a solar panel. You cannot print an ounce of silver. You must extract it. You must refine it. You must secure it. When silver gaps up while bonds wobble, it is the market voting for reality. It is the market saying that physical scarcity matters more than financial engineering. It is the market saying that the world is entering a resource-driven era. It is the market saying that the future belongs to those who control materials, not those who manipulate spreadsheets. You're living through a historic pivot. This is not a normal bull market. This is not a speculative bubble. This is a structural repricing of a critical resource. Your grandchildren will ask what you did during the resource crisis of the 2020s. Did you hold paper promises? Or did you hold metal? Friday was the test. Monday was the answer. The bear trap failed. London panicked. The path to 65 opened, and the market revealed its hand. But the journey ahead will not be smooth. The volatility will intensify. $2 swings will become 5. 5 will become 10. The market will try to shake you out. It will test your conviction. It will tempt you to sell early. It will punish the overleveraged. It will reward the patient. If you are trading with borrowed money, you will be washed out. If you're glued to the ticker, you will lose your nerve. The strategy is simple. Accumulate physical, hold strong miners, ignore the noise. The shortage is doing the work. The industrial demand is doing the work. The sovereign accumulation is doing the work. You do not need to chase. You are already positioned. The institutions will chase you. The hedge funds will chase you. The banks will chase you. The industrial users will chase you. The world will chase the metal you already own. That is the power of being early in a structural shift. That is the reward for conviction. The bear trap was the final warning shot. The London pivot was the confirmation. The leasing crisis was the spark. The gamma wall is the fuse. And the end-of-year window is the accelerant. The rocket has cleared the tower. The shorts are trapped. The float is gone. The squeeze is on. And now as the market prepares for the next phase, the only question left is not whether silver will rise, but how violently it will do so when the next wall breaks. Hold tight. The real move hasn't even started.